Jeff Snyder, welcome to Hidden Forces.
Hi, Dimitri. Thank you very much for having me. Really appreciate the opportunity to be here.
It's great having you on. So, Jeff, can you introduce yourself to our listeners? What do you do? How did you get into what you do? And how long have you been doing it?
It's a pretty long and winding journey. I right now I'm basically an independent researcher. I still do some investment advisory work with a company called Atlas Financial, but largely I've moved myself into the research area field of study because of really from way back in the beginning of my career, starting out as a portfolio manager. This is back in the 1990s, dot-com era, all that kind of stuff. And really to really understand the business, I started poking around in, of course, stocks and companies and balance sheets and income statements and all that kind of stuff. And eventually started looking at the banking sector. And I started looking at bank balance sheets, and really it didn't make any sense what we were, especially the commercial banking system. There was so much stuff going on there that you just don't hear about in the media. Didn't get taught it in school, any of those kinds of things. So then I started asking questions from people who've been in the business a long time, and really most people, the answer I got most of the time was, "Why do you care? Why are you asking these questions? This is the 90s. Everything's going great. Everybody's making money. Just put your head down and you get rich," which really kind of bothered me because there's a lot of this stuff going on. There's huge. I mean, what is a repo? What are these euro dollars? What are all, why are there so many derivatives suddenly? And nobody seemed to want to know. So I kind of took it upon myself to start really trying to piece together. And remember, this is pre-internet days. So this is, can I go to the library and find research material? And it provoked curiosity more than anything that led to, of course, more serious and determined study about what is really going on in the monetary system. Because what we were told, and what we're still told today, is it's all about the Fed. Don't worry about it. Jay Powell's got it covered. Back then it was Alan Greenspan's got it all covered. You don't need to know the details because it's all taken care of for you. And that answer really never satisfied me. Of course, then we got, the middle 2000s, the housing bubble, 2008 crisis, which was okay. Now it's really time to take this seriously because obviously we are missing something here. Because if Jay Powell or Alan Greenspan or whoever sits in the Federal Reserve chair has it covered, you don't get a 2008 crisis. So at the very least, that was the sort of the aha moment where, okay, this is the stuff that I was looking at, the stuff that I was really taking seriously, really was kind of really seriously consequential about what was going on in the system. So ever since then, it's been less portfolio management, more research, more focus, because this monetary system that actually exists out there is so much more complicated, so much more difficult to piece together, that even today, having done this for a quarter century, I'm still finding new stuff about it, still finding new information. It never ends. It's a rabbit hole that is incredibly deep.
Were there any books or papers or individuals that you spoke with when you began to go down that rabbit hole that were particularly useful or enlightening for you?
The book I actually started with was Milton Friedman and Anna Schwartz as a monetary history.
I actually saw in a video of yours, I can't see it in this video, but a different video, the dust cover of the book, and it looks like you're
Yeah.
using it to cover up a bunch of other files. It doesn't actually look like you've got the book underneath there.
No, it's
Oh, it is. Oh, okay,
I've
so you've
torn
got
this
post-it
thing.
notes. Yeah,
Yeah, I've torn this thing
yeah.
apart, and it actually has nothing to do with the Eurodollar system. It has nothing to do with the monetary system. But what was tremendous about it was Friedman and
The
Schwartz put
data they
together
compiled was incredible.
the research, the history, not just the concepts, but a comprehensive case of re-examining the monetary system. And for me, that was the template. It's like, here, this is the way I need to go about re-examining the monetary system that I'm seeing. I need to do all the research on the history. So rather than read other people's interpretation books and whatnot, I go back and I read old transcripts from FOMC meetings, or I read old research from,
Hmm.
the BIS. The BIS annual reports in the 60s are incredibly helpful. So I spent a lot of time digging through primary source material in the same vein as Friedman and Schwartz had, trying to piece together my own version, what made sense in my own head of what I was seeing in real time in the monetary system, and then matching that with how events have unfolded over the last couple of decades, and saying, Yeah, I think I've pieced together a good enough picture of what's really going on that I can understand things as they happen.
What were some of the glaring things that didn't make sense to you? And what are the things that people today do you think still get fundamentally wrong about how the monetary system works in a way that leads them astray in their
Well,
analysis?
the first thing is everybody has this model where money is it's government. It's the Federal Reserve prints money, or the Treasury Department, whoever it is. The government prints money. Banks are nothing more than a warehouse of government cash. And then there's a fractional reserve multiplication process, and voila, we have the 19th century version of banking. And that's really not the case. There's an entire wholesale system out there, interbank system, and there really isn't much cash involved at all. It is a virtual ledger system that has expanded beyond all sorts of traditional money boundaries as well as geographic boundaries. That's the maybe the biggest misconception of all, is that the US dollar is a domestic national currency, when it's really the US dollar denomination applies to this euro dollar system, which spans the entire world.
I like the
So
way
you
you
have
said that
banks.
this dollar denomination. That's an important point.
Yeah, so you have essentially what is a virtual currency ledger system that's been operating since the 1950s, where banks trade in US dollar denominations, but they're not trading back and forth. They're not paying in actual physical cash. They're not paying in gold bars, obviously. Bretton Woods broke down during the time. They're simply trading electronic liabilities that are called US dollars, that are denominated in US dollars. And if we're being specific, what they really are is claims on US dollars. So they're a derivative of a derivative. But essentially, it's a virtual reserveless cashless system. We call it the US dollar, but really it's a euro dollar system. So we have banks all over the world transacting in what they say are US dollars, but they're really not. So it's a euro dollar money system that goes all over the world, and it has undertaken the roles of the reserve currency, which makes it an incredibly important, not to just people in the US, but everywhere, because it is the global currency.
When you say they're really not dollars, is that because they're not a direct liability of the Federal Reserve?
Well, they're not dollars because there's nothing there. It's like I said, if you and I wanted to engage in a transaction where I paid you in dollars, I would have to put a physical piece of paper that has the Federal Reserve's, all the nice logos and everything on it, and put it in the mail, and you have to wait to get it in order to to
Yes.
extinguish our liability.
Fair. So that's a Federal Reserve note, but dollar-denominated deposits in the U.S. banking system by federally insured banks, licensed banks, are money good. They are equivalent in the way that the Federal Reserve treats them to Federal Reserve notes. Correct?
But it's
Whereas,
but
am
there
I
are still no
incorrect
Federal
there?
Reserve notes.
Right. I recognize that, but I'm saying in terms of, I mean, isn't the key distinction between there's also a whole hierarchy of money here, which is interesting.
Oh yeah.
And as the Federal Reserve, my sense of it is that, and we've seen this in a way in practice, that as the Federal Reserve has expanded the scope of assets that it's been willing to put on its balance sheet, it has imbued those assets with a money-like characteristic. So the Fed's willingness to absorb assets, doesn't that make those assets more money-like?
No, they were money like long before the Fed got there. See, that's the thing. The Fed is so far behind the curve that this stuff was developed in the 50s, 60s, and 70s, long before the Fed even started thinking about them. Think about things like Treasury bills, for example. They've been treated like money for decades. It didn't matter that the Fed was buying them or not buying. But getting back to your original question, what happened is essentially, because this is a global reserve currency system, and physical currency or physical money is a friction on that system, because you don't want to wait for physical pieces of paper or physical bullion to be transported vast distances. Isn't it much easier to exchange just ledger balances at the speed of light? So there's also this component of telecommunications innovations and advancements that goes along with this integration of basically a virtual electronic digital currency system, where instead of trading physical pieces of paper, we're just exchanging numbers on a ledger. And so these numbers on a ledger are technically claims on physical cash, but through very little time, the system realized that nobody wants the physical cash. There's no claim for physical cash from these claims. There's no need for that form of liquidity because the banks that operate throughout the world are more than happy to exchange nothing more than ledger entry balances. So it's a book entry system.
Isn't there a meaningful distinction between claims on cash that are circulating uh, outside the U.S. banking system and claims on cash that are circulating within the U.S. banking system? In other words, isn't there a meaningful distinction between euro dollars and dollars?
Not that I see. I mean, because there is no specific point of demarcation.
Well,
There is no.
those banks that are aren't financial institutions that are lending and borrowing in the euro dollar market ultimately reliant on swap lines, not themselves directly, but through their central banks to be able to get dollars to cover them in the event that they have a liquidity crunch?
No, the dollar swap lines came later as the Federal Reserve realized it was way behind the curve on this global dollar system. And the swap lines have been totally ineffective. Yes, they get used from time to time, but they don't prevent anything because the real issue here is in a ledger money system, the keepers of the ledger are the money. And that's the primary dealer bank, not the primary, the dealer banks. And these dealer banks don't have to be US banks. Now, there are distinctions, there are legal distinctions, but this, for example, a foreign parent bank may establish a US based subsidiary for a variety of reasons, none of which necessarily have to do with being connected to the Federal Reserve. They want to do business in the US. And this has been going on for decades. And what happens is banks very early on realized that they could transfer money easily between subsidiary and parent. So there was a seamless integration between what we would think was a domestic US based system, dollar system, and this external Eurodollar system. There really was, for a long time, no distinction whatsoever. Dollars flowed from the US to outside the US. They even flowed from outside the US to the US. In fact, I think that's one of the underappreciated factors of the Eurodollar system is that the United States domestic credit system derived a substantial portion of all credit from the external Eurodollar market, Eurodollar system. So there really wasn't a meaningful distinction between domestic US dollar and offshore US dollar. There is just only Eurodollar and all the various connection points to it. They did break down. There was distinctions during these crises because it becomes more difficult as dealers undergo balance sheet constraints that makes it more difficult for seamless integration. That's one of the central problems that led the Fed to say, we need to step in here. We need to try to step in here because this is way back in December of 2007. We said, we tried lowering interest rates. We tried encouraging people to go to the discount window, but we're still seeing all of these foreign banks and all of these foreign banks having problems in their US dollar funding markets. So let's try TAF auctions. Let's try dollar swaps to see if we can't get some kind of funding, some kind of discount window like mechanism open for the rest of the world. And of course, it didn't really work all that well because a couple months later, Bear Stearns failed. Then we get to the global financial crisis, the worst part of it, even though those dollar swap lines were open and active the entire time. So it's more complicated. And this goes back to what I said in the beginning, is that at every juncture, trying to research and understand the monetary system, what you find is that in the mainstream media and the way we're all taught is that this is really simple stuff. Money is very simple. The Fed takes care of things very easily. But at every step you learn things, and what you find out is that, oh, this is more complicated than you think. And then just when you think that you got that figured out, you think, oh, this is even more complicated than you think. And so that's kind of the progression that Federal Reserve officials have gone on ever since early 2007. They thought, well, we'll just lower some interest rates and that'll take care of everything. That didn't work. So they said, well, okay, now we got to get a little more complicated. So we'll try TAF auctions and overseas dollar swap. Well, that didn't work. Then they tried, well, okay, well, now we got to get into collateral because collateral seems to be a real issue here. So let's try the primary dealer credit facility. That didn't work. And then there was the money market fund bailout. There was it was just one thing after another, which just backs up the idea that the monetary system is incredibly more complicated than anybody's ever been taught to believe. And so that leads to all sorts of consequences, real world consequences, as well as consequences trying to understand what's going on here.
So I want to dig into that a bit more. What was it? What is it that has made it so difficult to what achieve? I mean, the Fed's even the Fed's own goals have been somewhat perplexing because officially they wanted to supposedly generate inflation or meet their inflation target, but there's also we did see asset price inflation that I think, and I would argue resulted in at the least in part from the reflation of central bank policy, but we didn't see that in consumer producer prices, which again I think that reflects the transmission mechanism. But I guess what do you think and please feel free to contradict anything I said. And what do you think the objective of central banks was, and why have they, besides the fact that the plumbing is more complex, as you say, than they recognize or their models suggest? What do you think the reason is that they haven't been able to achieve their objectives? So one, again, what has their objective been? Because that still is something that's been unclear to me. And why have they struggled to achieve it?
And that's the real question here, right? When we're talking about the Federal Reserve, I mean, there's real two different issues here. The one is the monetary system itself, and when you realize what the monetary system is, and we can talk about that all you want, there really isn't a place for the Fed in it. That's really the central issue here, is that the monetary system evolved way back in the 50s, 60s, into the 70s without the Fed.
So basically, the development of the euro dollar market in the 1950s, I think that's when euro dollars first started to appear. That was the beginning of the Fed's loss of control of the monetary system. Is that?
Yeah, and they talked about it all the time. Like I said, when I go back to primary source material, before Volcker, you saw all sorts of discussions and papers and everything about what the hell's going on in the monetary system. You know, these monetary aggregates that we just came up with, like M1, they no longer work. There's a famous paper by Stephen Goldfeld from Princeton, The Case of the Missing Money, 1976, where he said, you know, we thought we had money figured out. What we found out is that it evolved on us. Banks evolved on us. And think about it again in the context of a reserveless virtual currency ledger system. In a ledger system, banks basically have free reign to innovate and invent new forms of money and transactions, which they did. They came up with all sorts of incredible, sometimes elegant, sometimes horrific ways of doing all sorts of financial transactions that have every bit the weight of of using money in a system. But as they did that, the Fed realized they lost control, which led to all sorts of problems with Volcker, which leads us to today. What does the Fed actually do? Now, a central bank under the old Walter Bagehot doctrine is essentially about elasticity. And that's kind of what they try to say they do, but they realize we can't track the monetary system. We can't monitor it. We can't regulate it. So we're essentially stuck trying to do something from the outside. That's really nothing. That's really all interest rate targeting has been. First of all, it's an admission. We can't direct the money supply itself. So we're going to try to influence it by raising or lowering a what we hope is a main monetary interest rate federal funds. So that's even from that perspective, they're trying to influence elasticity from the outside. And just nothing more than realizing that, you can see, well, that might not be as easy as you think it is. And as you just said, Dimitri, the issue with the transmission mechanism is exactly that. When you're stuck from the outside looking in, and at best you're trying to influence behavior of the system from an external posture, you can have all sorts of problems with transmission because you're not inside the system. You don't really know what's going on, and you can't directly influence how money behaves. You're hoping, as Greenspan did throughout the 1990s, and if you read any of his speeches, including the famous irrational exuberance speech, what he said was, he wasn't saying the stocks were in a bubble. What he said was, we can't track the monetary system, so we wouldn't even know if stocks were. And nobody heard that. Everybody heard irrational exuberance and said stock bubble. What he was saying is that we're outside the monetary system looking in, and we only hope that this moving the federal funds rate around is enough of a predictable influence on monetary behavior that it leads to the best sorts of outcomes. Of course, that was completely obliterated in 2007 and 2008 when we had a specific monetary crisis where there was no agent of elasticity. The Walter Bagehot doctrine broke down because of all the complexities of this external world spanning reserveless currency system that the Fed was not really a part of. And so at every opportunity, the Fed tried to work its way back into the system, but it just couldn't do it. And so post-crisis quantitative easing, this doctrine of abundant reserves, what they've decided to do is, well, we brought the federal funds rate down to the nominal zero lower bound, which means we can't do any more rate cuts. So what do we got to do? Well, we do what the Japanese did, even though we know the Japanese didn't have any effect with QE. So they just create a bunch of bank reserves, hoping that has, again, an external influence on the internal inner workings of the monetary system, which has proven to be ineffective. As you said, Dimitri, yes, asset prices have gone up, but that's not because of money printing. That's not because of the Fed directly injecting these reserves into the system. Instead, we've had a monetary breakdown that has been proven to be durable and even permanent. The 2008 crisis was not a one-off event. It represented a paradigm shift in the inner workings of that Eurodollar system. And no matter what the Federal Reserve tries, it can't get the horses back in the barn again. So quantitative easing, again, is an external attempt at trying to influence behavior that it's not a behavioral problem here.
That's interesting.
So again, the major question, the overriding question here is elasticity. So before the crisis, you could argue the Eurodollar system got to be way too elastic because money creation was insane at that point. And since 2008, it has been, the pendulum swung in the opposite direction where it's been way too inelastic.
So let's break that down a second. I also want to clarify a term you used. I assume when you say agent of elasticity, you mean lender of last resort.
Yes.
Those are interchangeable terms.
Yes.
So you said the 2008 represented a paradigm shift. What are the characteristics of that? What are the specific characteristics of that paradigm shift? What fundamentally changed post 2008?
From a very high level perspective, it's really about behavior, risk taking. Because of recency bias, confirmation bias in the pre-crisis era, banks, the monetary system itself began to view its own activities as riskless. And so, if you convince yourself that everything is riskless, you'll do anything. And it becomes a game where everything is about bigger, more, because there's no risk involved with it. And there's a lot of reasons why that was the case. Again, as I said, recency bias. Nothing bad happened, so everybody believes nothing bad will ever happen. There's also
You're saying this was post 2008?
No, before 2008.
2008.
Yeah, everybody thought there was no risk in doing, the worst kinds of financial products ever. That's where subprime mortgages were not the problem. They were a symptom of this problem. Because when you have really internal constraints on monetary creation, money creation, eventually.
It's interesting because I feel like one of the lessons of 2008, I mean, I remember heading into 2008, people had some sense of boundaries around what the Fed was willing to and maybe even able to do. Some people had, myself included, a naive sense of what the Fed was even capable of doing. But one of the things that we learned with the 2008 crisis is that the Fed is capable of doing much more than we realized, and what it wasn't capable of doing legally, the government could simply change the laws and allow it to do those things. And I feel like in some ways the lesson was the Fed's going to be there to bail you out no matter what happens. So square that for me. How is it that you're describing an environment where people were more, where I guess not people specifically, institutions were more, were willing to take greater risks than they are now? Can you flesh that out?
Oh, again, like I said, because you had the great moderation period, number one. So there were no economic consequences, no downside economic consequences. And even the researchers who coined the term great moderation weren't sure where that came from. But what they said was we have a period where we don't have these periodic monetary interruptions or panics and things like that we've seen throughout history, which from the perspective of the banking system, the monetary system itself, you start to think that it's invulnerable because we did have a few bumps in the road along the way, including 1997-98 Asian financial crisis, which the system took that as, see, even when we have some relatively serious interruptions, it doesn't lead to the sort of breakdowns that we saw in the past, which means more risk taking. We can do more risk taking. And there's another part of this too. You have to remember, concurrent to all of this was the quantitative revolution, the introduction of complex statistical models, which were employed and played a big role in 97 and 98, Robert Merton, LTCM and all that stuff. But that was used widely starting in the 1990s into the 2000s, which bred this sense of invulnerability. We have all of these Ivy League mathematicians. We have these black box complicated models where we believe that we can map out every little corner of risk. And so it was the height of arrogance and hubris where you combine history with this new technology that hasn't really been tested, and it bred this Superman type behavior.
That's actually very interesting. So let me draw that distinction and see if this is what you're saying, so we can clarify it. It sounds like what you're saying is that we achieved a self-diluting plateau heading into the 2008 financial crisis, or peak or pinnacle, where we believed, or where institutional lenders and critical agents in the financial system believed that they had conquered risk, that we had we mastered it. And I think that makes a lot of sense. Would you say, though, the difference is that post 2008 we were humbled by what happened, but we replaced our sense of dynamically having, as a marketplace, having conquered risk with the Fed is just going to prevent risk from ever being a problem in the market because it's socialized it. Does that make sense?
It does. It does in one. Again, I think that's a common perspective. That's not the one I particularly share. I think what happened is the Fed doesn't factor at all, except that market participants know the Fed is ineffective, which in a world where you're aware that your risk models were completely worthless, that makes it even more, you become even more risk averse, right?
Ineffective in what? The Fed is ineffective in what?
Liquidity, elasticity. Goes back to that's the overriding characteristic of the last 15 years have been liquidity risks. Again, I know there's misconceptions here. When you look at the actual data, the level of credit and money in the economy has changed, completely changed.
But what you're describing
in the opposite direction.
Just to clarify, what you're describing, though, is ineffective in its ability to stimulate loan growth, right? Or credit, or the expansion of credit. Not ineffective in its ability to bail out institutions that have overextended themselves.
Yeah, but that's not the same thing as elasticity. That's been conflated. Those two terms have been conflated too.
Right, but I'm going back to the point about risk, just to clarify that it doesn't seem to me, in other words, and I really want to clarify this, because it doesn't seem to me that market participants are any more risk, or I mean, we've gotten to a point of risk taking in this cycle that I think was worse than what we saw in the mortgage refinancing boom.
In what sense, though? Because you don't see it in the credits, you don't see it in balance sheets, you don't see it anywhere.
Yeah, so I don't necessarily mean, and I'm not pointing to loan growth or credit growth. I guess I just mean, generally speaking, with people's willingness to lean into.
I think there's a distinction here. We have to distinguish between what institutions in the monetary system are actually doing, and what maybe was going on in the stock market, because those are two very different things.
Okay.
And so you're absolutely right. Risk taking in certain corners of those financial markets has been absolutely extreme, and for all the wrong reasons. The same reasons we've seen before, that we need to shelter ourselves from the Fed's reckless money printing, so we're going to buy stocks, real estate, and crypto. Right? Those are the assets. The risk taking has taken place since 2022 or since 2020. But that's not the monetary system. That's not the credit system, and that's why there hasn't been any real effect in the real economy. Going back to the very first part of QE. But what you said before is how did institutions react to the bailout of Bear Stearns, for example? Because you see a lot of things changed when Bear Stearns was bailed out. In the mainstream perception, popular perception, and the way central bankers tell it, Bear Stearns represented a huge success, because it sounded like this reckless subprime mortgage peddler was on the verge of insolvency, and we came in and we rescued it, just like we did in LTCM in 1997. Everything was fine, except everything was not fine. A couple months later, we had the worst crisis since the Great Depression. And one of the reasons why was managers at these money institutions said, they looked at Bear Stearns and said, oh my God, there really is a downside here. We could be wiped out. The management of Bear Stearns got wiped out. So if you're running another bank and you see Bear Stearns, who was not a subprime mortgage peddler, they were one of the most respected institutions longstanding on Wall Street for a reason. I could be the next Bear Stearns. I need to rechange and rethink and redo everything about my business. I need to reorient my operations from the ground up, or I could be wiped out. So the Fed looked at Bear Stearns and said, success. Wall Street and all of these banks around the world look at Bear Stearns and said, holy crap, this stuff is real. It really can lead to the worst consequences. And that's what kicked off the paradigm shift. And the paradigm shift is, before the crisis in these institutions, you could do any crazy crap that you could come up with. If you had a way to make money for your prop trade or your clients, you just went to your local manager and said, your desk manager, and said, I have this crazy exotic trade that I'm going to put on. And the manager would say, go ahead, do it. Nowadays, banks are run like utilities. You've got risk committees. All the management positions are staffed by lawyers and accountants. The way banks have operated has completely changed. They've become risk averse. What is it that Jamie Dimon called JP Morgan? He called it this fortress balance sheet.
How much
because,
of, oh, sorry, I didn't mean to
no, go
interrupt you,
ahead, go
Jeff.
ahead.
How much of that is regulatory, driven by changes in bank regulations, and how much of it is cultural or psychological?
It's all of the above. It started out as psychological. Holy crap, we're on an island. We could be next. And then, of course, Lehman Brothers, AIG, the nationalizations in Europe simply just reinforced the dangers, the downside, the liquidity risks of insolvency. And that kicked off this cultural shift. And then, of course, later on, you had regulations added on top, which codified what banks were doing anyway, but also made it a little bit more expensive to operate balance sheets in the way that we wanted before. And again, there's different ways to look at this. That was essentially, I mean, in one respect, that's a positive, because we don't want all of that reckless behavior that went on before the 2008 crisis to repeat. But what we don't understand is that we needed that behavior in order to operate the economy at maximum capacity. So we attempted, there was this major systemic shift in risk taking that in a sense should have been a good thing, but actually turned out to be a bad thing, because risk taking was required to operate the economy at its most efficient level. And regulations, they've added to it. But really, this goes back to the early days of the crisis. Banks had realized the downside and realized they needed to change.
So where have we seen these changes manifest most obviously or prominently? Because, for example, large blue chip corporations don't have a hard time borrowing money. So how did this change, and how was it also reflected in the profit maximizing strategies of the banking sector and of financial intermediaries that function in some ways as banks?
We got to remember, banks, any financial, they look at everything from a perspective of risk adjusted return. So even if nominal returns in, say, a risky asset they look really attractive, but if you look at it in the perception of credit risk, but also liquidity risk, even though the nominal return is attractive, you might say, nah, I'd rather just own a US Treasury, because risk adjusted return, there's no risk with the Treasury. Yes, there's interest rate risk and all that kind of stuff, but there's no liquidity risk with the Treasury, where there's tons of liquidity risk doing other sorts of things. So on a risk adjusted return basis, what the banking system has done is say, we'll lend to the safest, most liquid companies, we'll buy US Treasuries at almost any price, but we're not going to create loans for small and medium-sized businesses because we can get stuck with those.
Question: how much more of that lending became collateralized, and how important was that? In other words, also not only the willingness to lend to the government, but the increased reliance on loans collateralized with U.S. government debt.
Well, collateralization has been a huge part of this Eurodollar transformation from the very beginning. Especially in the 1970s, you saw the repo markets really rise with the advent of money market funds, which then created the wholesale conduit to really make repo part of it. And where it really gets, if you want to get into one of the more interesting complications of the Eurodollar, this wholesale system, collateral isn't what it seems to be either. In a repo transaction, they call it repurchase agreement because of the Fed, actually, but essentially it's a collateralized loan. So that's where the name repo comes from. if you and I want to engage in a short-term lending arrangement, federal funds, Eurodollar deposits, things like that, that are unsecured, I may not want to do that. I may want to cover some of my risk, so I might demand some collateral from you. And the better quality collateral you have, the more favorable the terms I'm going to give you, because then, as the cash lender, I want to be reassured that if you default on the loan, I have an asset that I can sell tomorrow and get all my money back. So when we're engaging in this repo transaction, my entire focus is on the liquidity characteristics of the asset you're giving me as collateral, which means if there's a dependable marketplace for that instrument, that's the best quality collateral. Doesn't matter about credit characteristics or anything else. It's all about liquidity characteristics. And it just so happens to be that the US Treasury market is the deepest, most liquid, most dependable in the world. So that's the best quality collateral. Now, where it gets complicated is, let's assume, Dimitri, you don't have any treasuries to post in a repo transaction. That doesn't mean you can't use treasuries in repo. You just have to go to your friendly dealer bank and say, I don't have any treasuries, but I want to engage in a repo transaction. The dealer bank will say, I don't have any treasuries either, but I know lots of people who do. And so the dealer bank will then borrow treasuries from either an insurance company, a pension fund, anybody who has large portfolios of treasuries that are otherwise sitting there, and says to the insurance company, do you want to enhance your returns a little bit? I'll give you a little bit of a spread. If you lend me your US Treasury, that I'll re-lend it to Dimitri, that Dimitri will then use in the repo market. So now it's gotten 3 steps more complicated. And usually you're putting up some other form of collateral. There's a collateral for collateral swap in there too. It's suddenly the collateral side of things gets far more complicated than you ever think. In fact, one of the reasons that AIG actually went down was because it was borrowing treasuries from its regulated insurance subsidiary so that AIG FP could repo subprime mortgage bonds. So what happens is, suddenly there's not enough treasuries because these treasuries get reused and repledged all the time. So there's almost a fractional reserve multiplier process on financial collateral. So there isn't enough collateral for the entire system. So there's always a persistent shortfall that is made up by this reuse and repledging rate. And if dealer banks become risk averse, they're less likely to lend you that treasury that you need in the repo market. And if they're less likely to lend you that treasury, that leads to all of these collateral squeezes and things like that. So it gets far more complicated, where in one of the most head-scratching parts of the pre-crisis risk-taking behavior, some of the worst mortgage bonds out there were treated as if they were treasuries. So you had a list of best quality collateral that was extensive for all the wrong reasons. And one of the biggest problems of the financial crisis that the Fed could never figure out, and really isn't set up to solve that problem, is we had a collateral shortage of epic proportions. Because once those mortgage bonds were treated more valued more properly, that herded everybody into the treasury market where treasuries were available, which there aren't enough to go around. So you had a massive collateral squeeze that created probably the worst parts of the crisis, especially in September and October of 2008.
So I want to actually give listeners a few episodes to go listen to, which I think will complement this one. Of course, Michael Howell, who often talks about the problems of collateral shortage. That episode was 265. We also did 3 other episodes that came to mind during this conversation. One is with Lev Menand, which focuses very much on the history of the Eurodollar market, the shadow banking system. We did an episode with Brent Johnson on the dollar, which ties into this conversation. And of course, Perry Merling on the history of the internationalization of the dollar system. Jeff, we're going to end up using this framework as we move along, but I'd like to bring us to 2022 and try and use it to understand, or at least to understand your perspective on what's happening here. So I think we started this conversation by me asking you, what do people most get wrong about the way the system works? What do people most get wrong, or what are people most missing about what is happening today in the markets?
Well, again, I think there's a misconception about what happened in 2020 and 2021. a lot of people said, here comes the inflation that we've been predicting all along, not realizing that if you've been predicting it all along, then it probably isn't the inflation that you thought it was. So what happened with consumer prices in 2021? Was it because the federal government and the Federal Reserve got together and printed money out of thin air, or was there something else? What is it that specifically changed in 2021 where suddenly consumer prices suddenly showed up? And the answer is that it wasn't money printing. It wasn't the helicopter stuff. It wasn't the Federal Reserve's QE. It was nothing more than a supply shock. We essentially very simple economics. The rebound in demand globally, not just in the US, but US in particular, rebound in demand happened much faster than the ability of supply to service.
But didn't the rebound in demand happen in part because of fiscal spending?
Yep, absolutely.
Fiscal stimulus. So then fiscal stimulus did have an impact on driving.
It had an impact, but it wasn't money printing. It just temporarily shifted the demand curve to the right.
Let's actually draw that distinction, because I think a lot of people use, myself included, use the term money printing, and we in some cases may use it. We all might use it in different ways to mean different things. Many of us may be using it in ways that we don't even understand. So what do you mean when you say money printing, and why is the government cutting checks to hand out to people not money printing?
Yeah, money printing is the monetary system itself, is not the Fed, it's not the federal government. Where does that cash? Remember, this is all ledger money. There's no physical cash, there's no gold bullion.
Is it
no
so for you, money printing is banks debiting, crediting other banks' bank accounts?
Essentially, it's bank balance sheet expansion. So when banks expand their balance sheet, they're expanding the available of, the lines between money and credit have blurred as part of this Eurodollar expansion. So for lack of more specific terminology, bank balance sheet expansion is equivalent.
So it doesn't need to be Federal Reserve notes. It could be the Fed buying $1 trillion of US Treasuries and crediting the bank accounts of their counterparties, and that's money printing.
See, that's where we get lost into the details and the minutia of, well, if the Fed does this, then this happens. And it's all this ceteris paribus. You get out your T accounts and say, this thing goes there, this thing goes there. What really happens is, on the very basic level, quantitative easing, let's just start there. Quantitative easing is nothing more than an asset swap, where the Fed is buying an asset that already exists on a commercial banking balance sheet. So the Fed isn't crazy. The Fed's balance sheet increases, but only because it's absorbing assets that already exist. So if the commercial bank already expanded its balance sheet, it's not money printing from the Fed, it's money printing from the commercial bank.
I understand, because they outsource it to the banking system.
And that's been the problem, though. We talk about the clogged transmission channel. What happens is the banks don't want to expand any further. So they're happy to pocket a small spread transacting with the Federal Reserve. And it's the same thing with the federal government. And the CARES Act and the expansion of the federal government's deficit in 2020, what happened? Well, banks created checkable deposits. So they created money, but it was only a one-time thing. So in 2020, they created a lot of checkable deposits that then were credited to the federal government, that the federal government then transferred to individual people who then spent their deposits. The deposits got circulated throughout the global economy, and that was the end of it. So it was a one-time, call it a helicopter drop if you wish, but it was a one-time thing. It was not a constant expansion of the monetary system. It was a one-time special purpose episode.
So it was a demand shock that resulted in a supply shock, which drove prices higher, which was transitory.
Yeah, and I think you had the supply shock anyway, regardless of whether demand. I mean, the shift in the demand curve made it worse than it would have been otherwise, because I mean, we had so many different things happen in the macroeconomic sense in 2020. I mean, so we started, buying things online in the ways that we never had before. And when we buy things online through Amazon, that means most of that stuff is produced overseas. So we had retail supply chains that were set up to filter goods through big box retailers and malls. Suddenly they had to go through Amazon. Well, it's not as easy to duplicate supply chains in that fashion. So whether or not the demand curve shifted at all, we still would have had that COVID shock of rejiggering the way that goods got from A to B. So there was a supply shock there existing.
I think I think one, it was pretty obvious that, and I don't know that, maybe I'm wrong, but I don't know that the Fed itself was making the opposite argument. It seems to me that it was obvious that we were having that there were price increases in various areas. It wasn't like a general increase in the price level. However, I do think that what we have seen is that no one, at least not anyone in these official policy institutions, really feels confident about his or her ability to forecast inflation or to really understand what causes inflation. And I think another one of these things is this more hand wavy sense of inflation expectations. This was a huge concern for a lot of people in institutional Washington and elsewhere. And again, I think, you know, as a non-expert economist person, speaking for myself, I think
Me too.
something else that makes this something else that makes this extremely complicated is that we had a very different economy in the 1970s when a lot of these models and these conceptions about what drives inflation came into vogue. We have a much two big differences are we have a much more internationalized economy today, and so therefore the sources of cost of of consumer price inflation can come from outside the U.S., for example. And then another one is we have a huge the economies could become more financialized and more unequal. So the ability of wage earners to exercise influence over the general price lever, over the general price, price level by demanding higher wages in anticipation of ever higher increases in prices also is diminished. So I don't know that anyone really understands what or can sort of confidently forecast inflation. I don't know. Do you agree with that, or because it sounds like you and there are other people as well that have had this level of confidence, which is, look, we can see the forward data. We can see that the economy is going to move into a slowdown. So this is going to be transitory. How do you think about that?
Yeah, I think this is the biggest issue we've had over the last couple of years is that we've conflated every form of consumer price acceleration with inflation. To me, inflation is specific. Inflation is always and everywhere a monetary phenomenon. Milton Friedman said it, central bankers believe it. And as we just spent the last almost hour talking about, central bankers they don't understand, they can't regulate, they can't monitor the money system. So if the issue is, are we experiencing inflation? Then the question is very simple. Is there too much money in the system? But central bankers can't answer that question, which is why they're left with all this other garbage. Inflation expectations. What is it that Jay Powell said earlier this year? We understand how little we understand about inflation. Well, yeah, because he doesn't understand money. So you have to look at the monetary system itself, which is impossible. You have to look at how the monetary system is interacting with financial markets and say, are we seeing the signs of excessive monetary creation in these financial markets that would tell us, yes, this is inflation like the 1970s because there's an excess of money. And really going back to the 1970s, for brief digression here, we still need to figure that out because there's really no comprehensive explanation that fits the facts of the 1970s either. Nobody talks about the monetary expansion in the Eurodollar, the international expansion of money that had a central role in the great inflation itself. But again, it's a very simple thing. Inflation, if it's inflation, we should see excessive money creation. And what the monetary system has told us from the very beginning in 2020, no, that was never the case. And so as consumer prices accelerated, the only way that it could happen was not money creation. It had to have been a supply shock. And if it was a supply shock, then it was always going to be transitory. It's always going to be temporary. The only question then is, how long is transitory going to end up being?
Was 2008 a breakdown in the refinancing mechanism, and the bailout was actually about restarting that refinancing mechanism, or was it about increasing the supply of money in the system in order to neutralize the excessive levels of credit that were causing a collapse in the refinancing?
Yeah, I don't, it's one of those things like the Great Depression. Would we have had a contraction without the deflation and the Great Depression? And I think, most people would argue that yes, we were in trouble in 2007, 2008, no matter what, because of the excesses of the pre-crisis era. Something bad was going to happen. But with the monetary system breakdown, a la 1929, 1930, 31, it made the situation much, much worse. That's what elasticity is supposed to be. Not to eliminate the possibility of a bad recession, but to make sure that the recession is only a recession, that the downside isn't a complete monetary breakdown where you have destructive deflationary tendencies. And I don't think the Federal Reserve was sophisticated enough to separate all of these particular topics. They should have focused on their primary job, which was elasticity. But again, as we've said, they don't know how to do that. So they mixed all of these things together. And essentially, again, I urge people all the time, if you have the time, read the 2008 FOMC transcripts. What you'll see is a bunch of clueless bureaucrats who are just throwing stuff at the wall, hoping something sticks. If you really go back and review the crisis, that's what they were attempting to do.
Well, that's
Just
kind of
trying to
what we've been seeing now. I mean, you want to talk about
Yeah, that's the thing though. They've learned nothing over the last 15 years because QE put everybody to sleep. Everybody thought, well, QE fixed everything. Therefore, we don't need to answer all of these lingering questions from 2008, even though we keep confronting them again, maybe not to the same degree, but we keep confronting these same problems. Collateral is still an issue that to this day, even though it was the central problem and fault line in 2008, because as you said to me, they're still just flinging stuff at the wall.
the collateral shortage you're talking about.
Yeah. The way the collateral actually works throughout the system has never really been examined, let alone.
So has quantitative easing actually constrained credit creation because it's reduced the supply of good collateral that can be lent against?
Yeah, there's all sorts of, you can definitely make that case. And I do make that case where quantitative easing is actually tightening because the central banks remove the best quality collateral from the system that actually needs the collateral more than the useless reserves.
So, okay, I want to ask one more question before I move us to the second hour, Jeff. I'm confused as to whether or not you view the lessons not learned as monetary in nature. In other words, that the Fed should have done things differently and that it can do things differently, or if the entire system needs to be reformed, which is a political problem which goes outside the bounds of what the Fed can do.
Yes, it's the latter.
Okay.
Like I said earlier, we don't want the banking system to be as stupid and reckless as it's been in the early part of the crisis, but we have to realize we needed the banking system in some respects, maybe not to the insane degree that it came to be, but we need risk-taking behavior to create money and credit to get the economy moving the way it's supposed to. And you're right. What the Federal Reserve on a very high level realizes is that they're not a central bank. They're not able to create elasticity in these types of breakdowns and deflationary moments. And so fixing the problem is not strictly a monetary issue. It is. It is. Let's be clear about that. But the Federal Reserve, as it is currently constituted, cannot fix this issue. So it is a political question as well as a small e economics question.
All right. So, Jeff, I'm going to move us to the second hour. I want to give listeners a sense of the topics that I want to hit. Of course, I do want to continue this rolling conversation that we're having of exploring the nature of the financial system that we exist within, as well as like avenues for reform of it. I also do want to talk about the BOJ's recent decision and yield curve control. I want to dig deeper into 2023 forecasts, 2023, 2024, a Fed pivot, so to speak. I think a lot of market participants are hanging their hat on this, hoping for a Fed pivot. It's really unclear what that even means. And it's also unclear how useful a Fed pivot will be, given that we might be in a setup here where we're going to see a huge deterioration in earnings. And how is that going to impact risk assets? And also an end game, just a kind of overall conversation about how this ends. Because my working model for all of this in general is that, yes, the Fed is very powerful, but the Fed is a political entity. And ultimately, I think that what rules the roost, what determines policy outcomes. Is ultimately political expediency. And my sense is that we're moving from this period of QE. We're not, well, we were from QE. Now we're in period of QT. But I think from QT, we go to fiscal stimulus, and we go to some, my sense is we go to a period, to a future where government spending has become an even bigger part of the economy. And that's a conversation I want to have with you, and I want to explore that possibility and sort of what that would look like. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Jeff, as well as the episode transcripts and intelligence reports, and if you're interested in joining in on the conversation, let me restate that. I'm so bad at these things. Episode transcripts, intelligence reports, and if you're interested in joining the conversation on our Hidden Forces Genius community, head over to hiddenforces.io/subscribe and check out our episode library. We can also become a premium subscriber today. Jeff, stick around. We're going to move the second hour to the premium feed.
Okay, terrific.